Hello, everybody. Welcome to the first ever episode of the AngelBrics Podcast, the podcast where we cut through all of the noise in the real estate investment market and make things simpler, clearer, and easier for everyday investors. Before we get started, a few words about me. My name's Ashley Osborne. A few years ago, I founded a company called PRSIM. We're principally involved in the sale and acquisition of large residential assets for large institutional investors. And what we've noticed when we speak to various people in the market is there's a huge knowledge gap between small investors and the way that large investors behave. And hence the reason for our AngelBrics podcast. We want to make things simpler for everyday investors. We don't have a course to sell. We're not trying to win your business. If you want to work with us, great. But what we really want to do is help distill some of the things that we've learned in our 25 years working in the real estate market in places all over the world and start giving some of that information back to people so they can make better, more informed residential investment decisions. Now, the first thing we wanted to do in our podcast was actually do something that we think is really fundamentally important. And that's whether you own a whole bunch of properties already, buy-to-let properties most likely, or alternatively, if you're looking at investing for the first time. The most important thing for everybody is to be able to analyze an investment and understand exactly what it's returning, where the risk is, and what you should be thinking about. So what we're going to do today is run through an existing property. We're going to pick one on Rightmove that's currently for sale. We're going to make some assumptions about what when it was purchased and some of those things, and then we're going to analyze it using our analyzer, which is called LEXIT, and it's available at LEXIT.tech. Anybody can use it. It's completely free. It will always be free. And you can analyze a property and have a look at what it looks like. So without further ado, I'm going to take you across to the LEXIT analyzer and analyze the property. Right. So here we are at the LEXIT platform, and what I'm going to do is analyze a property and just go through the results with you so you can sort of see some of the things I think that everybody should be thinking about if they're looking to invest in property. The property we're going to analyze today is this property. It's currently for sale on Rightmove. I'll put a link below. It's on Walworth Road in Elephant Castle. It's currently on the market for £600,000. So what I'll do is I'm not going to run you through how to set up an account. It's pretty simple. And as I said, completely free. What we're going to do is add the property and analyze the results. So let's, it's on Walworth Road. I'm going to put a photograph in so it looks good with the results. And it's an apartment. It's 2 bedrooms, 2 bathrooms. I'm going to say there's no parking space and an EPC rating of C. And I'll talk about that in a minute. The purchase price date, I'm going to say, is the 1st of Jan 2022. And let's say it's apartment 1 at number 1 on the street on Walworth Road in Elephant Castle. And the postcode is SE1. Right, let's put in the financial information. So let's assume we paid £500,000 for the property and that we put down a deposit of £75,000. That the market value today, let's assume that they're being a little bit optimistic, and we'll say it's worth £550,000 with a weekly rent of £700. I'm then going to put in my ownership type. I'm going to say it's owned in my own name. You could put it in a company. I'm going to say it's got a mortgage and that it's principal and interest, and I've got £425,000 currently outstanding at a rate of 5.5% with 20 years to go. I'm going to put in my property management fees. I'm going to say 10%. Service charge is 5972, and then the ground rent is 375. I'm also going to put in £750 in additional costs, so things like accountants, insurance, gas safety certificates, those sorts of things. And then also I'm going to put in my annual income. This excludes the property, so this is my income other than money from the property. I'm going to say I've got an annual salary of £80,000. I live in the UK and I've got the UK tax-free allowance. And then all you do is click this analyze button and it will give you the results. So what can we see? Firstly, the market value is £550,000, which is £50,000 more than what we paid. Perhaps surprising some people, the monthly income is actually negative, so minus £992 every month. The gross yield is healthy, 6.4%, and the net yield is healthy, 4.2%. But this is where things get interesting. And this is what I think a lot of people fail to do, which is actually look into the details. So it's got a performance dashboard that sort of says, where do we sit on the ranking? And what it sort of says is, look, you've got some problems you need to resolve. So firstly, the debt service coverage ratio. So all of these things have got explainers, so you can see what they do, but essentially what the debt service coverage ratio talks about is how much is your income relative to your debt servicing fees, and what is that as a ratio. So 1 to 1 would mean the income that you're generating covers your debt servicing fee. Anything below 1 therefore is bad, and generally speaking a number of greater than 1.25 would be considered healthy. In this situation, it's 0.66, and that's very bad. The OPEX load is another very important measure, which is how much is your cost relative to the income that you're generating. So that's things like service charge, maintenance, all those sorts of things. Good would be 20 to 25%. 25 to 30% people should be nervous, and north of 30% is very bad. So in this situation, we've got an OPEX load of greater than 30%. That's a real problem. Next, we've got our net return after tax. So how much is our percentage annual return on the capital that we've got tied up in the property? In this situation, no surprise, it's minus 14%. So you're not making money, you're losing 14% every year on the money that you've got out. That's a bad situation. Right. The next thing you want to look at as an investor is the cash flow. And the reason that's important, especially at the moment, is because what you're going to find is that at the moment, it's going to be very difficult to generate capital appreciation. So your critical thing is how much money am I generating every month or every year to make this investment viable. In this situation, we forecast the next 10 years. We show the gross rent, the operating expenses, what we're paying in mortgage, and then also the tax that's payable, and therefore what is my net income after tax. In this situation, it's minus £17,000 a year. So that is a real problem. It grosses it up over a 10-year period, so if things don't change, this property is going to lose £177,000 over the next 10 years in cash flow, and that's obviously a situation for immediate concern for anybody. You can get a little bit more detail as well, so you can get a breakdown of how you're paying off your mortgage. If you've got tax losses, you can carry forward. You can also see a graphical representation of the income you've got coming in. But also, we also set out for people, look, these are the assumptions we're making. And they are things like, we assume a vacancy rate of 2 weeks. That's pretty normal. We assume that there's going to be repair and maintenance of about 3.5% every year. And that costs are going to increase in line with inflation of 2.8%. They're obviously costs, but also income. We need to assume that there's some growth. We've assumed that rent will increase annually at 3.7%, which is roughly what we think is a long-term average in England. Probably a little bit high for at the moment, but realistically, you've got to look at averages. We're then also looking at what the property growth will be. We've assumed 3.4% for this analysis. That's very high. And we've also included income tax, which is in line with the UK tax rates as of the 1st of June, 2025. So that's basically the assumptions we've made. The next thing is, everybody talks about capital appreciation, so it's very important that we do that too. So what we've done is we've looked at what would your capital appreciation be based on different scenarios. Firstly, if there's no growth. Secondly, if growth is 1.7% compounding every year. Or alternatively, what happens if it's 3.4% compounding every year, which is essentially the long-term average in England. We then assume how much money will we get back if we sell it, based on those different income levels. We take account for any EPC cost upgrades. If we get it, we've got to get it from, say, D to C. We take into account agency fees, which we say are 1.5%, conveyancing fees, and then also capital gains tax. So in each of these different scenarios, we would get sort of minus £10,000, £67,000 or £155,000 if we were to sell the property. And that's based on the notional equity that we've got tied up in the property at the moment. So this is the equity we currently have. And what's our annual return on that equity relative to the different scenarios? So either minus 0.4, which is obviously bad, 2.5%, which isn't great, or 5.6%, which is pretty good, assuming everything goes absolutely swimmingly. The other thing that's changed recently in the UK is that the Renters' Rights Act is coming in. So it's important that people think about the risk that they're accepting as a landlord. We look at that in sort of two things. Firstly, it's a dispute budget. So we think that most landlords, that if they get into a dispute, it's going to cost you about 18 months rent. So in this situation, we're saying you need to be aware that you might have to pay £54,000 in costs if you can't get rid of your tenant, or you have some sort of issue. Or more importantly, can you afford to pay £3,000 a month for the next 18 months if the tenant doesn't pay the rent? And then the other thing as well is that people need to think about is the fines are now significant with the Renters' Rights Act. So you need to be aware that there's fines of between £2,000 and £7,000 per instance if you're in breach of the Renters' Rights Act. And the other thing that you need to also bear in mind is that if you have a dispute with a tenant post the Renters' Rights Act, they will have the ability to claw back up to 2 years' rent at any point in time. So that would be £72,000. So those are the things you need to understand and accept as a landlord. These are the risks that you're assuming. Now, obviously, landlord insurance is available, so some of those costs will be mitigated, but you need to know broadly what that cost envelope looks like. And then finally, what we do is we try and bring all of these things together and say to somebody, look, now let's look at what's your overall income, what's the growth that you might get over the next 10 years, and what does that ultimately mean for you as an investor? So firstly, let's say no growth, you had minus £177,000 of income, and then you lost £10,000. You would have a negative return of 6.8% on the equity that you currently have in the property. I'm afraid it doesn't get much better. Assuming the 1.7% growth rate, you'd lose £109,000 over the next 10 years after tax, which would be a negative return of only 4% in this situation. And even if things went really well and growth was sort of the long-term average, in this scenario, the investor would still lose 0.8% per year. So these are the things that you've really got to look at when you're looking at properties, either to analyze the existing properties that you own. Most landlords shouldn't continue to own a property that looks like this. And obviously, hopefully I don't need to say that if you're buying a property, this isn't a good one to buy. So this is essentially what we think is the minimum that somebody should be doing before they buy an investment property. And also what we suggest is if you own an investment property, you should be running this analysis at least twice a year. Some people do it quarterly, but from our perspective, twice a year is probably enough just to make sure that you're on top of your property. Because if you do have issues like this landlord would have, you can start to try and rectify them, but they can only be fixed if you actually know what they are. So that's the end of our first ever episode of the AngelBrics podcast. Something that we thought was really interesting to do for not only people that own property, but also people that are looking at property, and really to try and get into the bones of whether you're actually getting a good return or not. Hopefully you found that interesting. If you did like the content, please like, subscribe, share our information with other investors. I'll see you next time on the next episode. I'm Ashley Osborne, and thank you very much.